Welcome to Alpha Talks Editors Roundtable, what moved the markets this week for June 26th, the week ending June 26th. I am joined once again by my brain trust of Seeking Alpha editors, Bradley Olison, VP of News, Aaron Task, VP Contributor of Content, and Stephen Alfer, Managing Editor of Breaking News. I am Nathaniel Baker, host of this podcast and contributing editor at Seeking Alpha. It was a relatively quiet week, at least compared to previous weeks that we've covered. The big news appears to have been on the COVID front once again. Cases in the southeastern US and some other places out west have increased, and the markets apparently were concerned about that, and there was a big sell-off on Tuesday, I believe. Today, as we record this on Friday, stocks are down as well. Let's start off with Aaron, as we always do. Aaron, what's your take on the events of the week?
Well, it's interesting, you said it was a quiet week, and again, everything's relative, but there was a tremendous amount of economic news out, and as you mentioned, the COVID news, and I think that's the thing that's really gotten people's attention. Obviously, as of yesterday, we have a new record high number of cases in this country, and the 7-day moving average is very high. So, you had the huge sell-off in March, and you had the huge rebound in April, May, and the first part of June. And it looks like the highs on June 8th at around 3,200 for the S&P 500 are the highs for now. The market has held the 3,000 level on the other side. So that seems to be the new trading range. And I would think the next couple of weeks, the news flow will determine whether we break out to the upside or down below, or continue to chop around here. The rally, the rebound, was based on the idea that this would be temporary. We'd have a V-shaped recovery. Some of the economic data suggests a V, but if Texas and California, just those two states, if they're going back into lockdown, that's a huge part of the U.S. economy right there. So obviously that's the big risk, I think, right now that investors are looking at.
Yeah, Bradley, you cover this pretty closely, and you're very much in the weeds with the stocks that are moving on a daily basis. What's your take on this week?
So, there are a lot of cross currents. I don't know if we really want to get into some of the quarter end selling that we might be able to be witnessing here, because that's a huge factor that we need to take into consideration. Mm-hmm. Yes, it's COVID related. There's a huge amount of worrying COVID numbers out there. As Aaron mentioned, we're now at our highest daily rate, even exceeding when the Northeast was going through its trying times. Some of the biggest winners and losers, obviously, this week are the COVID-related names that we saw. It almost has echoes of the trade war narrative. Every time, the trade war was on, trade war was off, we'd get heavy selling in some of the semi-cap names and some of the, multinationals. Now we're seeing that same narrative play out with COVID. Cruise lines, Norwegian Cruise Lines, American Airlines, Royal Caribbean. We've even seen some retailers, Nordstrom, et cetera. Those are the big losers. Those are all the names that suffered the most in March during those biggest sell-offs. And some of the gainers, we're definitely seeing, investors moving back into Clorox, for example. McCormick, that's the spice food, cooking at home. That's the theme there. And some of the dollar stores, as people kind of stock up for the long haul to stay at home. So that's some of the top end themes that I've been witnessing. That big sell off on Wednesday, Gilead was one of the biggest movers in the S&P, and that's one of the major names that everyone's been looking at in terms of finding that cure or treatment for COVID. So definitely a COVID week, but you can't ignore some of the quarter end selling. JP Morgan estimated about $70 billion in negative equity rebalancing by mutual funds. You had about another negative $65 billion from defined benefits, and they basically estimate about $170 billion going into the quarter end in terms of some of the rebalancing. Some of that obviously may have been done already, but that's obviously a negative cross current in addition to these worrying COVID headlines.
I think the Fed stress test, which came out last night, I don't think there are any major surprises in the fact that the Fed banned any stock buybacks or dividend hikes through at least the end of Q3. I don't think any banks were planning on doing either anyway. But what was kind of surprising is dividends going forward are going to be based on kind of a a 1 year rolling average of what earnings are. So for the first time, I think the likelihood maybe of some dividend cuts from some of the big banks is in the forefront, and the banks are getting hammered today. I don't know whether it's because of the stress tests or just worried about another downturn in the economy. And another interesting point from this stress test was one of the Fed governors, Lael Brainerd, dissented from that action. She thought that dividends should be halted altogether until we're past all this. And Brainerd's a former high-ranking Treasury official, I think, under Obama, and probably on the short list to be Treasury Secretary if Biden gets elected.
Yeah, and the other thing I'd note, Stephen, I'm glad you brought up the financials, is that just yesterday, the OCC came out and gave the banks some relief on the Volcker rule and the amount of money they have to set aside for derivatives trades if they're trading within their own corporate entities. So it's a little bit of the regulators giving and then the regulators taking away on the stress test. But yeah, that action in the banks today is got to be a worrying sign, because the banks have lagged the overall market during the recovery. Obviously, the low and zero rates are putting pressure on net interest margins for them. But there's, I think there's definitely a sense out there among certainly people who remember the financial crisis that if the banks can't get going, it's going to be hard for the overall market or people to have faith that the overall market is going to keep in rally mode.
One of the better quotes I saw was that the Fed gave the banks a pat on the head and a kick in the teeth, which I thought was a great summary of exactly went down. And I mean, it's clearly not a massive risk-off move at this point. Wednesday we had the big five push higher. I think Alphabet's the only one in that category that has not hit an all-time high post-COVID. Facebook's up 19%, Microsoft's up 29%. This is as of the Tuesday close.
That's year to date.
Year to date, yeah. Amazon's up 50%.
Amazing.
So I mean, it's a far cry from blood in the streets here.
There's kind of this thought that the market's basically been straight up since the bottom in March. And I was just looking at the charts. We actually had a fairly sizable sell-off and sideways move in the first 2 weeks of May. And right now we're in a kind of a similar period, maybe in the last 10 days to what we saw in the first 2 weeks of May.
The sugar high that we're riding, either there's got to be more of it or it's going to wear off. And there's the fundamentals are going to either have to improve or the valuations are going to have to come down. And that's the ultimate. Right now, we're still in a bit of a tug of war between those things.
Yeah, look, I mean, even if you are of the belief that stocks always go up, as some people are, I'm not going to mention any names, Davey Day Trader, but even if you do believe that, you recognize there are down days, right? And down weeks, and it's never a straight line, right? I mean, 1999 wasn't a straight line. It was close, but even there you had some selling, believe it or not. So yeah, and this may have just been one of these weeks, where things consolidated a little bit.
Well, I'll hit everybody with a bit of real-time news, which I just saw come across my screen. Is now the Florida governor has ordered bars to close in that state. That follows earlier this morning, Texas Governor Abbott ordered bars there to close. So, if the reopening is going into reverse,
and we might see
I don't see how it's not bad news for the stock market.
Yeah,
right, for everyone.
Yeah, that's the fear that you look at there. All right, this segment of the show, we talk about our favorite articles and stories, some of which we may have edited ourselves. There was no celebrity news this week, so
yes, there was.
No, you spoke too soon. I believe you spoke too soon.
I did speak too soon. Take it, Bradley. Go ahead.
Oh, I mean, I don't want to steal anyone else's thunder if they were planning on going this route. I was hoping to stay away from it again this week, but it's very, very, very challenging.
You can't fight the Fed. You can't fight celebrities.
You can't escape the Kardashians.
It's not even exactly just celebrities. It's just the Kardashian family. Gap this morning gapped higher with news that they're forming a partnership with Kanye West, who, as some of our listeners may know, is married to Kim Kardashian West. We know her from last week's reference to Spotify. Spotify is one of the biggest performers, up 60% since the beginning of May, not the March bottom, just since May. Goldman was out with a note on Thursday with a new street high target, citing reaccelerating growth there for Spotify. But Gap was the news on Friday. They had the biggest move in their history, up more than 40%. I think they're holding some of those gains on Friday. That being said, off of a low base, right? They are retail. They have been impacted by some of the COVID. They were trading about 45% below their pre-COVID levels before the Friday jump, and they are still about 20% or so off those levels.
We should create a basket. We should trade a Kardashian basket of stocks. You got Cody with Kylie, Spotify, the Gap. I'm sure there are others, and look at their performance relative to the S&P 500. Like, we could create our own. That, you have the barbell trade, you have the prepper trade on one hand, and you have the Kardashian trade on the other.
There's a work from home ETF that was just launched.
There you go. Wow. There you go.
I thought it was interesting that didn't make too much news, but I thought important news with that is that Canada's credit rating was downgraded by Fitch. They've been a AAA rating for about 20 years or so. But their debt to GDP level has kind of exploded thanks to the pandemic and the response to the pandemic. They were sitting at a pretty healthy, like 88%, and it's jumped to about 115%. And Fitch expects it to eventually go up to 120%. And it's the canary in the coal mine. There's going to be probably other downgrades of other G10 countries, I would guess.
I think that the jokes were flying fast and furious as Canada lost its third A, right? It's now Canada.
That's good.
Right. Not my own. I wish it were mine, but
that's all right. You can pass it off. I do that all the time. All right, Aaron, what about your favorite stories?
Well, I know you're asking about stories on the site, but a couple of the things we haven't mentioned that we do want to highlight. Nike today is down 6+%. Yeah. Really shocking quarterly loss, and the margins got hammered, and inventories are up. So yeah, it's a rough outlook for them. They're closing stores, and that was also a theme this week. Apple closing more of its stores, and I believe I saw Microsoft said it's going to permanently close its retail outlets. Yeah. So definitely, obviously, COVID related there for Apple and Microsoft, but Nike that was ugly. I did, Nathaniel, want to put out one story because we've been talking a lot about obviously the Fed, and Fed's got your back. Just as a contrarian. Trading Places Research had a story out this week entitled "The Fed is not juicing the stock market," where they basically talk about that for as much as the Fed has expanded its balance sheet, that money is still either sitting in bank reserves or the U.S. Treasury account. And I'm looking for the quote here. Basically, the banks are hoarding the cash, not putting it to work. And he said, it's not so much, oh my God, the Fed's buying everything. It's, oh my God, 3 months into this, the banks are still scared to put their money to work.
All right, well, for a quiet week, that was quite a bit for us to talk about. So with that, thank you all for listening or watching, and we look forward to speaking to you again next time.